Eh, Welcome, everyone. I'm really glad you made time for this today. And we are right in the middle of the year, summer. And this is actually the most powerful window for tax planning that most business owners completely ignore. So wealthy don't play by different rules. They just use the rules on time. And that's what we are doing here. Over the next 45 minutes, I'm going to walk you through 5 costly tax mistakes that small business owners making a lot of times, and exactly how to stop making them before we lose the opportunity to reduce taxes. So these are not theory. It's going to be practical and very legal steps that can put thousands back in your pocket this year. Rajat, I see people on the lobby. If you can, please. Okay, I will accept them. I will keep it
Excellent.
simple. I will keep it simple and show you where the real dollars hide. And your job is to identify which of these mistakes apply to you and take actions while there is still time. Um, okay, and by the time we wrap up, you will know exactly which levers to pull so your tax bill tells you the truth. You're working hard all year round, and now you will keep more by using these rules. So grab your notebook and let's get started. First, I will tell you a little bit about us and how our services are different from other CPA firms. And then I will explain what tax planning actually is and how it differs from traditional services that 99% of CPAs are actually offering. Also, I prepared 2 case studies that show examples of how we helped 2 of our clients, and I will go over strategies that we implemented for them, as well as the savings generated as a result. Finally, I will walk you through the 5 costly tax mistakes that small business owners making and the specific strategies to fix each one before it's late. And at the end, if there is time left, I will be glad to answer your questions. If not, I will make sure to answer those afterwards if you email me. Before we deeper, I want to share something special that we prepared just for you as a valued attendee. We are offering a free diagnostic meeting with a CPA where we will review your latest tax return for missed opportunities and look at your overall tax situation. From that, we will give you an estimate of the tax savings available to you. This diagnostic is completely free and you will need to book it before the webinar ends to get a bonus. So, and as a bonus, if you decide to move forward and become a client, you will also get between $750 to $1,500 off your strategy session fee. So go ahead, scan this QR code right now to lock in your spot so you don't miss out on this limited time offer. At Custom Accounting CPA, we are not just traditional CPAs and enrolled agents. We are designated tax strategists who specialize in proactive, forward-thinking tax reduction planning. What makes us different is how we design and implement customized, innovative strategies that save our clients tens of thousands of dollars every year, using only IRS-approved and court-tested methods. We bring cutting-edge knowledge, advanced planning tools, and over 15 successful business owners, doctors, real estate investors legally minimize their taxes. That means we uncover hidden deductions that often missed, We identify special tax credits tailored for your business, and we leverage little-known provisions in the tax code to cut your tax bill, while also lowering your audit risk, which is very important. The result, you pay the least amount of tax legally possible and often see 200 to 300 plus ROI on your tax planning investment with us. Throughout the year, we have invested thousands of dollars to learn from leading tax experts across the country, investing in professionals, coaches, programs, and events to ensure we master the process the right way. At Custom Accounting CPA, sorry, wrong slide. At Custom Accounting CPA, we hold elite and unique certified tax coach and certified tax planner designations that less than 1,000 other tax professionals have the privilege in obtaining in the entire United States of America. In the last 3 years only, we helped to reduce our clients' taxes by over $4 million through leveraging tax code and implementing basic and advanced tax strategies. Most business owners don't realize there is a huge difference between tax preparation and tax planning. And think of it this way, tax preparation is like looking at the rear view mirror. It's backward looking. Your CPA takes your prior year numbers, files the return, and makes sure you are compliant. But at that point, history is history. There is almost nothing you can do to reduce your tax bill. And that's how most accountants still operate, reactive, not proactive. Tax planning, on the other hand, is like having a GPS. It's forward-looking. It takes into account your business, your life, your goals, and the tax code before year-end, while there is still time to make changes. That's where the real savings happen. So while tax preparation is just a compliance service, tax planning is one of the smartest investments with a massive ROI you will ever make. It leverages the law to help you pay the least amount of tax legally possible, year after year. Most CPA, tax preparers, accountants save you very little on the largest expense of your life, which is taxes. They just preparing your returns to stay in compliance. Therefore, tax preparation is a cost, something you have to pay to comply with IRS, while tax planning is an investment that has the highest return on investment that you possibly get elsewhere. To put it in a perspective, if you invest $1, doubling 20 times tax-free, you will end up with $1 million, as shown on the left. However, if we take into account taxes at assumed 25% tax rate, you will only end up with $72,000. Huge difference. This illustration shows how taxes are our biggest expenses of our life. It also shows that without tax planning, the more you make, the more you pay in taxes. Now let's go over 2 real case studies that shows how we are helping our clients to reduce their tax burden. This is Josh, a 35-year-old dentist. Like many business owners, he was filing his taxes on Schedule C of his personal tax return and overpaying the IRS every single year. The very first year he started to work with us, we were able to reduce his tax bill by $37,000. And we continue to deliver around the same savings for every year going forward. We didn't change his lifestyle. In fact, we lowered his audit risk at the same time. The major savings came from the advanced entity structure that we suggested for him. We helped him restructure into 2 separate entities, one S corporation for dental products and one C corporation for dental services. That allowed us to shift income to lower tax brackets. His personal brackets dropped from 30 to 20%. and the C corporation portion was taxed at 21%. That restructuring alone saved him over $21,000. Additionally, we did owner compensation study where we determined a reasonable salary that Josh should pay himself. The salary was calculated to ensure it is reasonable in the eyes of IRS, but also, very important, minimizes taxes due for Josh. It was calculated based on hours, tasks, industry standards. This is not only minimize his taxes, but also provided audit protection. That saved him another $6,500. Because we lowered his taxable income and optimized his reasonable salary, he now qualified for the QBI, Qualified Business Income Deduction, which is first 20% of your net income is tax-free, saving additional $3,500. And finally, there were few missed business deductions that we found that were not claimed by Josh. For example, he was not claiming depreciation of his home office as well as cleaning services he paid to clean his home. That was additional $6,000. In total, Josh saved $37,000 in federal taxes in 1 year, plus another $6,000 to $8,000 at the state level. And the best part, those savings will grow as his business grows. Now, let me ask you, what would you do with an extra $30,000 to $40,000 back in your pocket every single year? Now imagine if you found an extra $30,000 to $40,000, not just once, but every year. That's not just saving on taxes, that's building long-term wealth. And that's the power of planning. If Josh didn't just invest in 1 year of savings, but instead invested every year for the next 30 years, his tax savings alone would grow to almost $5 million by age 65. So those are two extremes. On the one hand, investing just once gave him nearly $500,000. On the other hand, investing every year built a multi-million-dollar retirement fund. But the truth is, you don't have to do either extreme. Even if you invested just 30 to 50% of your tax savings every year, you would still be setting yourself up for a secure and comfortable retirement. And that's the turning tax planning into wealth building. Now let me tell you about George, who is a software developer and 42 years old. So he came to us while still having his accountant to file his taxes. He told us he loved his accountant, had been with him for 10 years. First year, we simply did a comprehensive tax plan for him, but he stayed with his accountant to file his taxes. Even though his annual fee with his former accountant was not huge, he was mainly paying for tax preparation. And that mistake was costly. George ended up overpaying $31,000 in just 1 year. Multiply that by a decade, and it's over $314,000 lost to the IRS. Here is why his accountant was simply filing returns. Looking backward without applying proactive strategies, George was getting exactly what he paid for: compliance, not savings. So what did we do for George to turn things around? We applied 5 core strategies and saved him $31,000 in the very first year. And here's how we did. First, we showed him how to generate tax-free income worth about $6,000 annually. Next, we implemented a Section 105 health reimbursement plan so his business could pay for his family health insurance premiums and medical expenses pre-tax. That alone reduced his taxable income and saved nearly $10,000 per year. We helped him open a solo 401k and contribute $20,000 that saved him another $4,000 annually. Plus, it gave him options for self-directed investing and even up to $50,000 in accessible tax-free loan funds. Then we suggested he hire his son to work in the business. That created another $3,700 in savings. And yes, I will walk you through this strategy in details later. Finally, we identified he qualified for research and development tax credit, which delivered another $8,000 in tax savings. The result, we turned a pattern of six-figure losses into tens of thousands in annual savings. And here's the takeaway. Well, the wrong advisor doesn't just cost you their fee. It can drain hundreds of thousands of dollars from your wealth without even you realizing it. So ask yourself, if George was over $1,000 every year, how much might you be leaving on the table? All right, with those two examples in mind, let's talk about you. There are some strategies that you can take before year end, during the summer, that can make a real difference. And I'm very excited to show you the 5 easiest one to start with. So, when do you usually think about your taxes? If you're like most of the business owners I talk to, the honest answer is twice a year, when they are due and when they hurt. April hits, you see the number, and you think, that cannot be right. And then you go back to running your business and you don't think about tax again until next April. And I totally get it. I understand how business owners are busy, but there is what that cycle is actually costing you. You are 6 months into this year, your revenue is taking shape, your expenses starting to add up, and right now, there is still enough time to change what you will owe on December 31st. October, we can still do some things, but a lot of most powerful moves would be already off the table. Next January, it's totally over. At that point, you are just reporting what happened. So summer is the perfect window. Right now is when proactive tax planning actually moves the needle. And that's why we are here today. So before I get into the mistakes, I want you to see what we're really talking about. A business owner earning around $200,000 a year, someone just like many of you on this call, could potentially save $20,000 to $40,000 per year just by shifting from reactive to proactive planning. Let that land for a second. That can be a whole vacation. That's a year of college tuition for your kid. That's money you could pour back into growing your business instead of writing a check to the IRS. The only question is, are you currently leaving that on the table? And I'm going to show you today exactly how those savings happen. And more importantly, what's standing in the way. So mistake number one, this one hurts a lot when I see it because it's so common and it's so fixable. And here's what's happening. If you are operating as a sole proprietor, or if you are structured as an LLC and taxed as a sole proprietor, every single dollar of your profit is subject to self-employment tax. That's 15.3% on top of your income tax. So for every $100,000 in profit, you are handing $15,300 to the IRS before you even get to income taxes. Now, here's the thing. The S corporation structure was literally designed to reduce this. When you're an S corporation, you split your income into two buckets: salary and distributions. The salary gets hit with payroll taxes. But what about the distributions? No payroll tax. And we are talking about typical savings of $8,000 to $20,000 per year on the exact same income. Nothing changes about what you earn, just how it's structured. A $100,000 business saves around $6,480 by making this switch. And again, this comes just from structure change. Now, here is the critical piece. There are still several months left in this year. If you act now, there is still time to implement this and capture savings for 2026. Wait until October, November, December, you're probably looking at next year. So the action, review your entity structure now. Don't wait. This one I see across the board, and it's also painful because the money is sitting right there, just waiting to be claimed. And most business owners paying their health insurance premiums, their medical bills, their family healthcare costs with after-tax dollars. Imagine if you are in 32% tax bracket, for every $10,000 in medical expenses you pay out of pocket, you needed to earn about $14,700 before taxes to cover it. You are giving away $4,700 every single year for no reason. Here's how you fix it based on your business structure. If you're an S corporate owner, your health insurance premiums must go on your W-2. When that happens, they become deductible. It takes a small administrative step, but the savings are real. If you're an SC corporation, you can use 05 HRA to reimburse your entire family's medical expenses tax-free. And if you are an LLC or partnership, one of my favorite strategies, hire your spouse. You can reimburse family medical expenses at the level of their wages. So basically, instead of paying wages, you will pay medical reimbursement. And those reimbursements would be tax-free to your spouse and fully deductible to the business. And because of how it's structured, you can also eliminate FICA payroll taxes on those wages. So every dollar of medical expenses you pay pre-tax is 37 cents saved if you're in the top bracket. And that adds up very fast over a year. So summer action, get your HRA or W-2 health structure set up now. Don't wait when the year is over. And let me ask you a different type of question. Would you rather write a check to the IRS or write a check to your future self? And I know it sounds obvious, but this is exactly what's happening when business owners don't have retirement strategy in place. Most of business owners missing is the solo 401k. This one is one of the most powerful tax reduction tools available to a self-employed person or a small business owner. And the number that stops people cold when I show them, you can potentially save over $30,000 in taxes per year using this one strategy. And here's how it works. You can contribute as an employee up to $24,500 in 2026. You can contribute also as employer, roughly 25% of your business income. And if you are 50 or older, you can get additional 7,500 catch-up contributions. The total can exceed $70,000 per year. Every dollar you put in reduces your taxable income dollar for dollar. But here is the deadline that catches people all the time. The plan must be established by December 31st. You can fund it later, all the way until your tax deadline, but the account has to exist by year end. And I see this happening every single February when business owner calling us after the fact saying, I heard about solo 401k. Can we do it for me? And we have to tell them that no, you missed the window. So you still have it now. The window is open right now. Start the setup process today and don't let this December deadline surprise you. And this might be the most important slide of the entire webinar, because this mistake is the reason all the other mistakes keep happening. And tell me if this sounds familiar. You have an accountant, you like them, they're very responsive, they file your return every year, the fee seems reasonable, but are they calling you in June with strategies? Are they proactively reaching out mid-year to say, hey, I looked at your numbers, here is what we should do before December 31st? Or are they waiting for you to send them your documents in February to file taxes? So if it's the latter, you have a tax preparer, not a tax planner. And I want to be clear, there is nothing wrong with tax preparers. They do very important work, but tax preparation is a cost. It's a compliance. Tax planning is an investment. And I want to think about George that we just in one of our case studies. He loved his account and the fee was reasonable. But what George was paying was for tax preparation. And over 10 years, that loyalty cost him more than $300,000 in unnecessary taxes. Just because he was not doing proactive planning. So think about it. When did your CPA last call you with a strategy? And the next one, mistake number 5, business. Every February I get calls, business owners who just heard about this strategy. It's called Petit. It's Petit election, or prepaying expense, or setting up depreciation reimbursement for personal assets. And they want to implement it in February for prior year. And I have to say that these are great strategies, but unfortunately it was closed on December 31st. Those are not complex strategies. Those are actually core basic strategies. They just require actions before the year ends. And let me walk you through a few quickly. So Petit election is a pass-through entity tax election available in most states. This is a state deduction. Instead of you personally paying state income tax, your business pays for it. That creates a federal business deduction, lowering your adjusted gross income. So on 300,000 net profit with a 5% state rate, that's $3,600 in federal tax savings alone. But the payment has to happen by December 31st. Next one, 12-month rule. You can prepay up to 12 months of rent, insurance, software, subscriptions, and deduct in the current year. If you pay in December for the next 12 months, that's this year's deduction. Now, depreciation reimbursements. If you use your home, your car, your cell phone for business, your company can reimburse you for the depreciation on those assets. It's a non-cash expense. You are not actually spending money, but you get a real deduction, and it's tax-free cash back to you. And finally, hire your kids. If your child is under 18 and does real work in your business, you can pay them up to $16,100 in 2026, completely tax-free to them. It comes off your income and goes to them at a 0% tax rate. Now, the petite election and the 12-month rule have a true hard stop, December 31st. Miss that date and the strategy is gone for the year. But for depreciation reimbursements and hiring your kids, it's a little different. And this is important. These strategies don't disappear if you wait, but they shrink. The benefit is prorated by how many months are left in the year. Start today in July, you capture 6 months of reimbursements, 6 months of wages. Wait until November and you are down only to 2. The strategy still works, but you have left most of the savings on the table by that time. So whether it's a hard deadline or shrinking window, the answer is the same. Summer is your runway. Use it. Now I want to take a step back and just remind you that these aren't loopholes, these aren't gray areas. Those are strategies the tax code was literally designed to offer you. Congress wrote this rule specifically to incentivize business owners to invest in their businesses, plan for retirement, create jobs, and build wealth. The IRS is not hiding this from you. They're sitting right there in the code. The business owners who use them are simply working with someone who knows what's available and has the time to implement it. And here's a few more strategies that I love. Employ your spouse. We quickly mentioned it before. And reimburse your entire family medical expenses through their wages, eliminating FICA taxes. Again, instead of paying wages and payroll tax, you will reimburse the whole family medical expenses for the work your spouse will do as a payment for the work. Rent from your spouse. Another strategy. If your spouse owns your office space or property you use for business, you can pay fair market rent. That income moves from your Schedule C, where it's taxed at 15.3 self-employment rate, to your spouse Schedule E, where there is no self-employment tax. And on $24,000 annual rent, that's $3,400 saved every year. UBI deduction. The first 20% of your qualified business income may be completely tax-free. Most business owners know it exists, but very few actually knows how to maximize it. R&D credit, research and development. This applies to far people think. If you're developing software, processes, products, or methods, you may qualify. Worth $8,000 plus annually for many businesses. And these strategies work together. A well-structured plan that combines even 3 or 4 of these can reduce your tax bill between $20,000 to $50,000 every year. Keep in mind, the sooner in a year you implement employ your spouse and the rent from your spouse, the more you will be able to reduce your tax bill by. Every month you delay is savings that you cannot get back for this year. Same as for depreciation of your personal assets and hiring kids we just discussed a few minutes ago. And let me put real numbers on this for you. You're a business owner, you make $200,000 a year, and here's what proactive tax strategy looks like broken down conservatively. S Corp structure optimization between $10 to $50 per year. Solo 401k between $8,000 to $15,000 per year. UBI deduction and income shifting, $5,000 to $10,000 per year. Health strategy and family employment, $3,000 to $8,000 per year. Year-end timing strategies, $2,000 to $5,000 per year. Conservative combined total, $28,000 to $53,000 saved per year. And I want to be very clear, this is not magic. This is proactive tax planning. The people who are keeping this money are not smarter than you. They don't make more money than you. They just have someone who sits down with them, reviews their situation, and implements these strategies systematically. And this is exactly what we do. I want you to take a mental inventory right now. Be honest with yourself. Does your CPA proactively contact you mid-year with strategies? Or even better, quarterly? Do you know today roughly what you will owe on December 31st? Has your advisor reviewed in years? Do you have a retirement account specifically designed to maximize tax reduction? Have you ever received a written tax plan, not just a tax return? If you answered no to most of those questions, you are overpaying, period. Because nobody's in your corner proactively fighting for you. That has a cost. That cost compounds every year. Let me show you what it looks like when someone is in your corner all year long. January through March, we are filing last year's return, but we are also reviewing what structures need to be in place for this year. Entity setup, retirement account setup, payroll structure. April through June, mid-year check-in. How's your business tracking? Are the estimated taxes payments right? Do we need to adjust the owner's salary? July through September, this is where you are right now. This is when we implement deduction strategies, run a year-end tax projections, and get any retirement accounts established. This is the most powerful planning window of the year. And October through December, executing. PT payments, prepaying expenses, finalizing family payroll, locking in every strategy we identified. Our clients don't get a surprise tax bill in February. They see it coming months in advance, and they change it. And you're in the most powerful planning window of the year right now. The question is, what do you do with it? So where do you start? Here is the exact process we walk every new client through. Step 1, free tax savings assessment. We review your most recent tax return, look at missed opportunities, not from a compliance angle, from a planning angle. What did you leave on the table? Step 2, your estimated tax reduction. We put a real number on it, not you might save something. A special dollar figure based on your actual situation, your entity, your income, your family structure. Step 3, a written tax plan, a custom roadmap for your business, the strategies that we will implement, the deadlines, and the expected savings. Step 4, implementation and ongoing planning. We don't hand you a document and walk away. We execute the plan with you, monitor it throughout the year, and adjust as your business evolves. And most of our clients reduce their tax bill by $20,000 to $50,000 or more in the first year alone. And here is a bonus for anyone watching right now. If you book your consultation before this webinar ends, you will save between $750 to $1,500 on your strategy session fee if you become a client. The savings expires when we stop presenting, so don't put this off. So I want to close this with something important. The business owners who consistently keep more of what they earn plan proactively all year long. Let's recap the 5 mistakes we covered today. The wrong entity structure, paying unnecessary self-employment tax on every dollar, paying medical expenses with after-tax dollars when you absolutely don't have to, no retirement strategy, funding the IRS instead of your own future, confusing using tax prep with tax planning and paying for compliance instead of the savings, and missing monthly strategies. They're not in place. It's the money you have already left on the table. You cannot go back and recapture it. Are you making some of this? Most business owners, a lot of business owners are making all 5. And the good news is every single one of these is fixable, and you still have time this year to fix them. Scan the QR code on your screen that I will show soon and book your free diagnostic meeting with our team. We will review your situation, show you what's available for you, and give you a clear picture of what you could save. No string attached. And only 3 new client spots open each month. So if you are serious about this, act now while you're still thinking about it. Now that you have seen these 2 case studies, you might be wondering whether tax planning is really a fit for you. And how do you know if you're a good candidate for a tax planning? So the simple answer is if you feel like you're paying too much in taxes, you probably are. And that means you can benefit from proactive tax planning. And here are the clients who typically see the biggest results. US-based business owners making around 500,000 or more in gross sales. Anyone who is paying at least $20,000 a year in taxes. High net worth individuals who want to protect and grow their wealth. Now, if you are strictly a W-2 earner, your options are more limited. But if your wages are at least $300,000 or more, or you have other investments, we still have strategies that can make a big difference for you. The bottom line is this: if you're paying significant taxes every year, you are exactly that kind of person who can benefit most from what we do. And as I mentioned earlier, our tax plans don't just save you money, they also help reduce your audit risk, because everything we do is structured, documented, and IRS approved. Our plans typically deliver at least 200% ROI, but in many cases, it's much higher. It can go up to 500 or even 1000% ROI. And think of it this way: for every $1,000 you invest in working with us, you can expect to reduce your tax bill by $2,000 to $10,000. Most of our clients, as I mentioned before, end up cutting $20,000 to $50,000 or more of their taxes every single year. And just imagine what it could mean to your business, your family, your future. So how we can actually help you to stop overpaying? We have 3 options depending on where you are in your business journey. Entity analysis, compensation optimization, $2,500. This is a perfect investment. This is perfect if you're just getting started or want to make sure your foundation is strong. We will set up the most tax-efficient entity structure and optimize how you pay yourself to minimize taxes. Then comprehensive tax plan for $5,000. For established businesses, this is a full standalone plan. You can keep your current CPA for compliance, and we will be your strategists to ensure you pay the least amount legally possible. All-inclusive ongoing tax planning is $1,000 per month, and this is our most popular option. It includes a comprehensive tax plan, unlimited quarterly projections, ongoing updates if laws or your business change. And it also includes filing your business return to reflect the strategies we put in place. The bottom line is, whether you are just starting out or already established, we have a level of service that will fit your needs and deliver significant return on investment. Now that you have seen the different ways we can help, let me show what this looks like in real life. And here's a quick story from one of our clients who felt the same way you might be feeling right now, and what happened once we start working together. And at this point, I would love to open it up for your questions. Go ahead and type them into the chat, and I will answer as many as I can. Before, again, let me remind you of this special offer we prepared for you, just as a valued attendee. And it looks like we don't have any questions coming in. So before we wrap it up, let me leave you with this. You've just seen how others legally slash their tax bills, and now it's your turn. Don't let the IRS keep what's yours. Scan the QR code right now and book your free assessment before this webinar ends. And remember, spots are limited as we only take on about 3 new clients each month. And thank you so much for joining me today. I truly look forward to helping you keep more of your hard-earned money and achieve your financial goals. Have a great day, and I hope to see you in a strategy session very soon. Bye for now.